Hello, my name is Nanette Abuhoff Jacobson. I'm a multi-asset strategist at Wellington Management, and I'm delighted to be joined by Danny Cook, also a strategist and co-author of our Outlook, Inflation is Here, How Long, How Strong. We'll spend the next 15 minutes sharing our second half of the year outlook, and I'll start at a high level with our key views and recommendations. So we have 4 points for the second half of the year. The first one is that we are still making vaccination progress. That's a key theme for the recovery. And so the recovery is proceeding. We also still have policy support. And so our stance in terms of portfolio positioning is still to be pro-risk. There is a but. And the but is that we are facing a few challenges. One is that the inflation backdrop is getting worse in terms of higher inflation. Second is that we've got a Delta variant that could be causing a slowdown, though we think it's temporary. And then the third one is that policy support, while still we think is supportive for a risk environment, but it is not quite as supportive as it was in the second half. Okay. But our bottom line is that we are still in a recovery, and therefore portfolios should be positioned in favor of equities over bonds. And within equities, we are favoring more value-oriented regions. That is specifically Europe and emerging markets equities. Both these regions would be levered to a global recovery, and Europe in particular, we're seeing really big acceleration in underlying fundamental data. The third point is that we think inflation is stickier than the Fed thinks and the market thinks. And we see this in a lot of data that we're monitoring, and therefore in a reflating economy that should benefit the most inflation sensitive assets, which are commodities. So we favor an overweight there. The fourth point is that we continue to be moderately bearish on government bond yields, but we're expressing that in Europe mostly, where we are bearish. Rates have risen in Europe, but much less so than in the US, where rates are about 100 basis points higher than they were from there about a year ago. And so we want to express that bearishness in Europe as opposed to other parts of the developed markets. Now, with those 4 key points, we also want to highlight some of the risks to our view. And the first one on the downside is that we get a spike in rates. Now, this could be because of unexpected inflation, or if the Fed accelerates its tightening stance, we could see the short end rise quite a bit and the yield curve flatten. Any kind of preemptive Fed tightening, we think, could upset markets. And the second thing is, as I mentioned, the Delta variant. This is now in 85 countries and representing most of the infections in the world. And the key is whether this is going to cause sustained restrictions in business activity and consumption. Now, there's an upside risk also, and that is specifically that we're seeing a CapEx boom, certainly on the private side, and government spending for infrastructure, green initiatives is really ramping up. And this could cause productivity to improve by quite a bit. And that is really kind of the magic elixir for markets, growth without inflation. So if we look at the next slide, we can see the snapshot of our views. So what I'll be doing is going through the asset classes on the left-hand side, and then our recommendations on the right-hand side. So again, starting from a high level, we prefer equities over fixed income. Moderately bullish on developed market equities, and I would describe our risk stance as fairly low, just given those headwinds that we're facing. Within developed market equities, we're neutral US equities. Europe, we're bullish. and Japan were neutral. Again, in Europe, we're seeing the healthiest acceleration in the data, and it's, of course, cheaper than the US. And we see this in confidence in manufacturing and consumption as well. In emerging markets equities, we are moderately bullish as well. Of course, China is key to this view. The consensus is that China is slowing, and that represents 40% of the MSCI EM index. But we think China will get through this just fine, that credit will bounce back, and the recovery that has been concentrated in the manufacturing sector will migrate to the consumer sector. In commodities, we're moderately bullish. As I said, this is our best expression of our inflation view, that inflation will rise and be stickier than most forecasters believe, including the Fed. And we have not only a cyclical view behind this, but a structural view that CapEx has really been constrained for various reasons, and therefore inventories will stay tight. In government bond yields, we are moderately bearish, and we're expressing that mostly in Europe, where rates are most negative and are most vulnerable to the recovery that we see occurring in that region. And then moving to the credit side, overall, we're neutral. You might wonder why. Spreads are very tight right now, but we do see some exceptions to that, and so that's where we're positioning. We are moderately bearish on both investment grade credit and high yield credit, but we do see some value in bank loans. Emerging markets has really lagged in terms of spreads, so we like valuations there. And then in the securitized markets, again, we like the assets that are exposed to the residential housing market, which we think will continue to be strong, not only from a cyclical perspective, but also from a structural perspective. Okay, I'm going to pause there and turn it over to Danny. Danny, what are you looking at? What are you seeing in the fundamentals to give you confidence that portfolios should be positioned with a pro-risk stance?
Great, thanks, Nanette. So I can start off by saying that we're still bullish on global consumers and services coming back. Now, the Delta variant may slow or delay the recovery in some areas, but ultimately huge chunks of developed markets in particular are opening back up. And we think that there's a lot of pent-out demand out there, especially for services. So despite increasing prices in many areas, we think it's really noteworthy that consumers still seem really buoyant. The US and Europe saw consumer confidence at multi-decade highs last week, and we continue to think that consumers will be additive to global growth. This chart is just kind of one attempt to visualize that idea. It shows US airport security checkpoint traffic, which has come back pretty strongly, but we think still has some room to run. So as Nanette mentioned, in the context of pretty small position sizes, we are modestly overweight equities, and within equities, we prefer Europe. The rationale for that, besides attractive valuations and supportive policy in Europe, is that the European vaccination campaign is growing much faster than the UK or the US, which already hit its peak vaccination rates. And so the turn in the cycle in Europe could be pretty strong, whereas we fear that the second derivative of growth in the US will probably be negative in the second half. Now, Delta does have Europe squarely in its sights, and we're acknowledging that by slightly reducing the overweight. But we're hopeful that A, Delta is not really a secret. It's probably priced in. We've seen pretty big moves already with leisure and hospitality stocks. And B, it will hopefully be more of a near-term concern, and Europe will be out of it for the bulk of the second half. We continue to see higher inflation, and we do have conviction in near-term inflation. We think the vast majority of the near-term leads point to strong inflation. We're a little bit less sure about longer-term inflation and suspect inflation will peak at some point in the next 6 months or so, and then return to a lower level, but still a level that's higher than what we've seen on average in recent memory. And so to play this, we recommend being overweight commodities broadly. We continue to see higher inflation and have conviction in near-term inflation. We think the vast majority of near-term leads point to strong inflation. We're a little less sure about longer-term inflation and suspect inflation will peak at some point in the next 6 months or so, and then return to a lower level, but still probably a level that's higher than what we've seen on average in recent memory. And so to play this, we recommend being overweight commodities broadly. And I'm going to turn it back to Nanette to talk through how these fundamentals could impact assets.
Great, thanks, Danny. So, a big question for investors is whether equities give you inflation protection. And I think the answer is yes and no. And what we're seeing in this slide is some research that the team did looking at risk asset performance versus break-even inflation rates from the early 90s, break-evens being a proxy for inflation. And what our research showed is that when inflation is rising from low levels, from inflation levels of 1% or even zero, then inflation is really beneficial to equities and other risk assets. And the reason is that companies then gain pricing power. But there's a threshold at which inflation rises above that 2-3% level, and then that becomes negative for equities and risk assets. And so where we are now is a really interesting juncture because we do see inflation rising. The big question is how persistent it will be. And we do think there's a risk that inflation could be persistently higher, maybe even above that 3% level, which we haven't seen in many decades. And therefore, you need some added protection in your portfolio. The way we're expressing this is to be leaning toward value-oriented sectors in the equity markets, in commodities, and also regionally having overweights outside the US. So I am also going to talk about another topic that clients are really interested in, which is the value trade over. This quarter value has really struggled and growth has outperformed. And we think that's because rates have dropped at the long end, because the Fed accelerated their tightening path, and also because of fears of the COVID variant. What this chart is showing is just from a valuation perspective, value has barely gotten started. We think that we are still in the fairly early phases of the recovery, and therefore value should resume its outperformance relative to growth. And certainly from a valuation standpoint, value has a lot of runway to close that gap in valuations between value and growth. Okay, now I'll turn to credit spreads. Here we have a picture of where spreads are in percentile terms. And the message here is that credit spreads are rich. And the only exception to that is emerging markets debt, where spreads are quite a bit higher. But you see, just as an example, US high yield is in the 4th percentile. We're at around 268 basis points over treasuries, and the absolute low since the inception of the index was 233 basis points. So really looking pricey in that particular sector. Now, why are spreads rich? Well, they are supported by excellent fundamentals. The default rate in the high yield market is under the long-term average. It's running close to 3%, and the long-term average is 4%. So really good fundamentals. And of course, the technicals are positive too. We're seeing demand from foreign investors into the US markets. Hedging costs are quite a bit better than they had been. And also pension funds, their funded status has improved. And so they're locking in that better funded status with long corporates and other credit. So that's why overall, we're not bearish on the whole sector, and we do see some value, particularly in bank loans. If the Fed does accelerate their tightening path, the short end is likely to rise, so that's good for floating rate assets. As I said, we also think valuations in emerging markets debt look interesting at this point and should really close the gap. And we can see that on the next slide, which shows that high yield looks really quite rich to emerging markets debt. So that wraps up our high-level comments and our second half multi-asset outlook. Just to summarize, we think the global recovery is intact, and that supports a slight overweight to risk assets. That said, we are mindful of the risks, and those are the COVID variant, the Delta variant, and we're watching to see if that negatively affects business activity and consumer confidence. We're also watching the Fed and what its reaction function is to growth and to the inflation environment. And then finally, there is an upside risk, which is we're seeing a big lift in CapEx investment by the private side of the economy and the government. And this could be the holy grail for improving growth and limiting inflation by increasing productivity. So we'll stop there. Thank you for listening, and we'll see you next time.